Bad data used to tank the markets. Now it launches face-melting rallies that feel almost irrational. Weak jobs, contracting manufacturing, record consumer debt, and somehow green across the board. Either markets have evolved into a new species of bad news as good, or we are dancing blindfolded on the edge of a cliff with CPI holding the knife. Let's talk about why this bounce looks less like strength and more like a beautifully baited bull trap. Here is what we're covering in this video. The full story of this week's rally, what drove the prices higher, and why the logic is not sustainable. Positioning risks and a market structure leaning on fragile supports, macro cracks we cannot ignore, job softening, ISM contraction with sticky prices, and stretched consumers. The full technical breakdown, levels, setups, and trade ideas will be in my free newsletter before Monday's open. So grab the link below if you want to see it before the bell. And we'll wrap this video with next week's economy calendar and earnings events that could flip the script fast. 2 weeks ago, the market finally acknowledged reality. Jobs were revised down hard and the soft landing story cracked, and we saw a clean flash lower. You would think that would set the tone for a grind lower. Instead, the market flipped and ripped back higher like none of it mattered. This week, prices kept climbing while the macro picture kept softening. Prices up, fundamentals down. That disconnect is the heart of this week's story. Starting with jobs. The headline looked fine, but the internals cooled. Fewer full-time hires, and more people are taking part-time work for economic reasons, and job openings continue to drift lower. Over the last 3 months, hiring momentum is the weakest since the first rebound after COVID. Outside of 2020, as the softest in years. Normally, that's when positioning switches to risk off. This year, softer data makes traders think the Fed will ease, so they buy more. Revisions told the real story. When prior months get caught by big numbers, the job picture wasn't as strong as the headline suggested. Wages aren't accelerating, hours worked are slipping, and income growth is cooling. And that usually means softer spending. That's not the backdrop where the valuations expand easily. Here is how the crack showed up this week. ISM manufacturing stayed below 50. New orders were soft and prices paid stayed too high. That's the stagflation mix we've been calling out for months. Slower activity with sticky costs, and the data keeps backing it up. It squeezes margins and it makes guidance harder. Normally the market asks for a discount here. Today it's actually paying a premium. Speaking of stagflation, services doubled down on it. Service sector employment slipped while prices paid pushed higher. Same theme, softer hiring with sticky service inflation. The market is priced for smooth disinflation, but services are still the sticky part. Consumers tied the narrative together. Household debt is at record high. Credit card delinquencies are rising, student loans are back, borrowing costs are higher, and savings are thinner. That bites into discretionary spending. You see it in the numbers: slower sales, smaller average purchase amounts, and more cautious guidance. Classic late cycle behavior. So with growth slowing and prices sticky, why did stocks go up? Because this week wasn't a new growth story, it was mechanics. When SPY is in negative gamma, dealers buy as the market rises and sell as it falls, which amplifies every move. The front of the IV curve tipped into backwardation. That's when the near-term IV is above later month. Short-dated risk is elevated, hedges got expensive, and the squeeze fed on itself. It looked like conviction, but it was plumbing. If you're unsure how options Greeks, specifically gamma, are used by market makers to drive price action, watch my options Greek video where I do cover this in full detail. Continuing this theme, buyback added fuel to the fire. July buyback announcements were at a record high for the month. As we flagged in the AI Mania recap, corporations are the steady buyers while insiders and institutions cut exposure. That hasn't changed. Institutions sold in 10 of the last 11 weeks, and the insiders were net sellers at 90% of companies. In plain terms, these jumps are mostly fueled by corporate buybacks, with a bit of retail activity, not big institutional money piling in. And with August trading volume so light, every move looks bigger than it really is. Concentration raised the stakes. The top 10 names carry an outsized share of S&P 500, and tech and AI-linked leaders drive the tape. If one giant stumbles, the whole index feels it. Nvidia is big enough that one earnings call can swing the market's mood. That's dependence, not diversification. Right now is basically a one-theme market. Tech is more than half of total US market value, while defensive sectors are barely a factor. That means most macro talk is really just tech talk. Semis, AI buildouts, cloud, software. When so much money sits in one theme, the whole index swings with that theme's volatility. Policy headlines actively moved the market this week also. News of a proposed 100% tariff on Chinese chips hit the wires, briefly lifting some semiconductor names before traders started pricing in the risk of higher costs, delayed investments, and disrupted supply chains. Even rumors without official confirmation moved prices, showing how sensitive this space is right now. We also saw Apple rally about 5% on Friday. It was driven by extreme options volatility, most notably a 20 million put sale that temporarily suppressed short-term volatility and shifted dealer positioning. Technicals told the same story, a relief bounce. In last week's newsletter, I flagged the potential for a move up to close the open gap, and that's exactly what happened. In fact, prices pushed beyond the gap. The more detailed technical breakdown will be in the newsletter before Monday's open, so make sure you're on it. From here, the path splits. Cool CPI, the squeeze extends. Dealers chase, buybacks continue, and we float toward the next resistance pocket. Hot CPI, and the story flips. Yields jump, growth wobbles, and the same negative gamma mechanics push the other way. Classic late cycle tape. Traders look tired, breath is thin, leadership is narrow, and policy noise is loud. The screen might look calm, but the backdrop is noisy. It wouldn't take a full recession to shake this up. Just one big earnings miss from a leader or an inflation print that breaks the easy disinflation narrative. I'm not calling a crash, but I'm flagging a mismatch. Softer macro pulse, fragile structure, and a calendar that can flip risk quickly. Cool CPI, the squeeze has room. Hot CPI, that rising wedge can crack the way the wedges do. The bottom line is, this rally drifts until gravity shows up. And next week, the CPI is the gravity. With the macro recap out of the way, this is usually where I break down the charts. But similar to the last few recaps, I'll be covering them in the free newsletter. The link is below. Now that's out of the way, let's see the macro reports and earnings coming up for next week, the events that could actually flip this market script in an instant. On Monday, we don't have anything scheduled. On Tuesday, we have CPI. The big swing factor, hot print could spike yields, and cool print could extend the squeeze. On Wednesday, we have a lot of Fed speakers. On Thursday, we have jobless claims, PPI, including the core PPI, which is a key inflation gauge that the Fed watches closely for policy decisions. On Friday, we have retail sales, industrial production, business inventories, and University of Michigan sentiment. On the earnings front, on Monday, we have Barrick Gold, Oklo, AMC, and more. On Tuesday, we have Kava, H&R Block, and more. On Wednesday, we have Cisco, Equinox Gold, and much more. On Thursday, we have JD.com, John Deere, Applied Materials, SanDisk, and more. On Friday, we don't really have anything important. To wrap things up, let's go straight into closing thoughts and connect it back to the themes we broke down earlier. This week's bounce eased the pressure from 2 weeks ago, but it doesn't erase the bigger picture. We got softening macro data, narrow leadership, and a rally popped up by mechanics rather than fundamentals, the exact mix we broke down in the last market recap. That kind of rally works right up until the moment it stops. So stay nimble, respect your stops, and remember, bad news is good doesn't mean risk is gone. The market can ignore reality for a while, but not forever. If you enjoyed the video, hit like and subscribe. And if you don't want to miss the chart breakdown and key technical levels, make sure you're subscribed to my free newsletter. The link is below. Thanks for watching, and I will see you in the next one.